We tend to judge how rich someone is by looking at their monthly paycheck or the cash they have on hand. It is a natural assumption to make, but it completely misses how money actually works. This graphic shows the actual wealth ladder, broken down into 8 distinct levels. True wealth isn't defined by your salary. It is defined by 2 metrics: how wide your margin of error is and the accumulation of your non-cash assets. At the baseline, we have extreme poverty and standard poverty. Here, you are living on a few dollars a day, and your daily choices are strictly about survival, securing food, clean water, and shelter. You cannot budget or invest your way out of this tier because it is governed by systemic constraints, like illness and a lack of basic infrastructure. Then there is relative poverty. Your physical needs are met and your bills are paid, but financial constraints block you from participating in normal social life. While your peers are interacting on modern smartphones, you are playing Snake on an old Nokia. You survive, but you are isolated by your lack of purchasing power. Escaping those bottom tiers usually requires external intervention or systemic change. But once you cross into the middle and upper levels, advancing up the rest of this ladder is entirely dictated by mathematical financial strategy. The first step into that strategic territory is the lower middle class. People at this level operate as financial min-maxers. Their entire strategy relies on budget optimization. They secure stable jobs, cover their housing and utilities comfortably, and make highly pragmatic choices. They buy a reliable Toyota instead of a luxury vehicle because they know exactly how to stretch a dollar. Move one step higher to the true middle class, and you reach a financial Goldilocks zone. Your income covers your core needs, leaving enough room for minor wants, like upgrading your phone every few years, or taking a vacation without spiraling into financial guilt. But both of these middle tiers share a critical vulnerability. They operate with almost zero margin for error. A sudden shock, a medical emergency, a job loss, or a major car repair will instantly break their financial stability. The middle class successfully trades the daily panic of basic survival for the chronic anxiety of being exactly one bad event away from disaster. Above that anxiety sits the upper middle class, a group commonly referred to as Henrys, high earners not rich yet. These are specialized professionals and senior managers. They generate a high-tier salary and immediately allocate that cash into premium convenience, nicer neighborhoods, actual club memberships, and frequent lifestyle upgrades. This strategy yields a high perceived social status and exceptional day-to-day comfort among their peers. This graphic demonstrates the comfort trap. For the upper middle class, lifestyle costs rise exactly in tandem with income. Every raise is absorbed by new expenses, leaving zero actual wealth accumulation. Being asset poor, their vulnerability is massive. If W-2 income stops, their entire lifestyle collapses. Moving past the comfort trap brings you to the genuinely affluent and multimillionaire tier. The strategy here is inverted. Affluent earners deliberately suppress lifestyle inflation so they can channel their high income directly into non-cash assets. True financial security only happens when your net worth is completely decoupled from your daily labor. This chart visualizes an affluent portfolio. Wealth is diversified across real estate, stock equities, and business ownership. Actual cash is only a tiny fraction of the pie. Achieving this tier requires you to ignore the short-term social signaling of the upper middle class and instead embrace the quiet discipline of building foundational capital. Above the affluent sits the multimillionaire threshold. This is the point where your net worth features multiple commas and your purchasing power scales drastically. The shift at this level is entirely psychological. Financial decisions are no longer driven by necessity. They are driven strictly by personal preference and passion. Wealth at this scale is largely illiquid. You could be robbed on the street and lose nothing, because your money exists as business equity and property deeds, not cash in a checking account. Finally, we cap the scale at the billionaire tier. Here, capital is used as a tool to influence policy, fund early-stage tech, and restructure major corporations. The math at this level is difficult to process. A billion is 1,000 millions. If you spent $1,000 every single day, it would take you over 2,700 years to run out of money. For anyone mapping out their own financial independence, the billionaire tier is entirely irrelevant. It is an unrealistic target that distracts from functional planning. For 99% of people, highly functional wealth peaks at the affluent tier. That level secures the only three resources you actually need: health, time autonomy, and options. Moving up the ladder relies on a single mathematical equation. It is the gap between what you earn and what you spend, multiplied by time and applied to investments. This diagram outlines the advancement protocol to find your strategic requirement. The first question is, does your income cover basic needs? If yes, but you lack a safety net, your outcome box is to build the buffer. Your primary directive is to play pure defense. Save aggressively to widen your margin of error against sudden economic shocks. Ignore the temptation to look wealthy. If you make six figures but feel stuck, the flowchart asks, are lifestyle costs growing faster than investments? A yes means you're in the comfort trap. Your directive is to permanently cap your lifestyle costs. Stop increasing your luxury consumption and trade that heavy cash flow for aggressive capital purchases. The final requirement is finishing that conversion. You take your active labor income and lock it into passive assets, building a system that turns autonomously. Separate the appearance of wealth from the reality of wealth. Depreciating luxury items like the newest phones distract you from acquiring actual time autonomy. Crossing the line from making choices based on necessity to making them based entirely on preference is the ultimate milestone. Advancing up the wealth ladder is a deliberate behavioral choice. You trade the fleeting appearance of present-day status for the reality of permanent financial autonomy.